Well, welcome back to U.S. Farm Report here from top producer in Nashville. Great panel lined up to not only talk about commodity prices, but also input prices and possibly where we're heading amidst some of the uncertainty there. Dan, I want to start with you because you recently made a trip to Brazil. You kind of ground truth some of these estimates that we're getting about the South America crop. So the question we all want to know is, how good is Brazil's crop this year?
Brazil is really good, Tyne. It's a record crop. If you think about Brazil, we think the crop is all of 154 million tons. That's 1 million tons above the USDA. And as harvest is starting in Mato Grosso, the yield data that's coming through, they're about 9% harvested today is record. So as we go south, it'll be a little bit more questionable of Rio Grande, which has been too dry, but the northern half of Brazil is really good.
Matt, I mean, this isn't really news. We knew Brazil was good. We knew Brazil was setting on a record crop. Is this, do you think, already baked into the prices that we're seeing right now?
I mean, this has been more of a soybean meal story than anything because Argentina was dry. And so obviously you know that Argentina puts quite a bit of soybean meal, usually 50% or more, out on the world market. So, you saw the soybean meal take off and go around December 1st. Bean market was heavily supported by that. But whenever you look at the grand scheme of things, what Dan's saying, I mean, South American production is going to be up overall. And you have to understand, we're building world stocks, even at a time when Argentina had a really tough weather pattern. So, you can't get too bulled up just based on Argentine weather.
Well, Sam, I know the biggest concern right now for growers is, okay, if we do see these prices continue to retreat and see some pressure, where are we going to see input prices head? And I know that's something you explore. Let's specifically talk about fertilizer. We've seen natural gas come down. Do you think fertilizer prices continue to come down?
I think that's our bias, our base case scenario is that you still see some downward pricing momentum in the potash and the phosphate market. Nitrogen is always going to be a little bit of a wild card, probably geared towards some downward pricing pressure in the first half of the year with that unknown about what happens in the European market with regard to energy prices, potentially causing some kind of volatility at some point. But as with everything, we are waiting on the Brazilian market. Brazilian pricing for fertilizers tends to be a little bit of a lead indicator to global prices, primarily because of their import needs relative to other geographies. So while there's downward pricing momentum, near term and at the moment, depending on the demand out of Brazil, we could see some flattening in that, some kind of correction, but I think the bias would still be to some double-digit downward price and momentum over the coming months.
Dan, but the reality today is we have retailers that are setting on what it sounds like overpriced inputs, right? And so we are still seeing high inputs at the farm level. So as a producer, hearing how good of a crop we are seeing in South America, question marks about Argentina, but what are you telling producers right now? What should their game plan be for 2023?
Well, I think first we need to start in 2022. I would tell the room you probably need to be sold out of corn and soybeans for 2022. I don't see any reason to be storing old crop corn and soy. That being said, I think we need to think ahead to 2023. In the last 2 years, it paid to be relatively bullish, and that was for demand reasons. This was a supply rally. This is because of Argentina, a USDA estimate that was lower than expected. We think that supply peak has come in, and unless somebody else has another weather problem, I think selling December corn between $6 and $6.20 of next year and November beans at $13.80 to $14.20 makes a lot of sense.
Matt, you along those lines too?
Yeah, absolutely. I think that the January 12th report essentially gave a little bit of a bolster to the old crop market. I mean, you see a 1,242 carry, and obviously 8.9% stocks to use is quite snug, but at the same time, you took 185 million bushels of demand away, and I think that starts to spell issues whenever you move, 1,242 even into the supply and demand balance sheet for next year, and you start running the math. Even if you increase demand somewhat, 175 to 180 bushel yield, you're going to have a hard time getting below 2 billion. So I'm really concerned that we're going to base too many of our decisions in 2023 on 2021 and 22 profit margins. We need to get that out of our head.
Sam, how long does it take for some of these prices that we're seeing then on the global level to trickle down to the farm level and see some of these input prices start to retreat?
It's quite spotty. You never get the same consistent level of fundamental supply across all product groups and across all geographies. I think when a falling price kind of dynamic, there is a reluctance to necessarily hold too much in the way of inventory at the distribution and retail level, and that can cause some, need to amplify the scarcity concern at the grower level. So It will come. It will come. We saw some inland prices taken down 10% at the wholesale level just a couple of weeks ago, and I think that that's probably reflective of what's happening in the Brazilian market. So it will come, but it won't be instant. I don't know, there's a few weeks lag, month lag kind of dynamic.
Okay, well, we talked a lot about supply on commodity prices, but we need to get into demand. We need to get into China and look longer term at China as well. We'll do that later on the show, but please stay with us. We'll be back with more U.S. Farm Report in just a moment.